Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 145. And in this episode, we are reviewing the performance of the global markets during the fifth week of 2025. And that is from Monday the 27th to Friday the 31st of January 2025. And without further ado, this is your host, Jamhuri. And together, let's dive right in. We kick it off by looking at the headlines this past week, where Chinese AI firm DeepSeek released an open source reasoning model that claims to rival OpenAI's models in both cost and performance. This announcement has sent shockwaves through the tech industry, particularly impacting major players like NVIDIA. Investors are worried that DeepSeek's innovation could reduce the need for expensive graphic processing units, which are essential for training and running advanced artificial intelligence systems. On Monday, NVIDIA's stock fell by 16.9% and lost close to $600 billion in market capitalization, which was the biggest single-day drop for any company in U.S. history. DeepSeek's cost-effective and high-performing model threatens to disrupt the boom in artificial intelligence and raises concerns about the competitiveness of U.S. tech companies and America's leadership in the artificial intelligence sector. Staying in the United States, on Wednesday, the Federal Reserve announced it would leave interest rates unchanged, and this decision comes as inflation continues to run above the Fed's 2% target rate. The Fed's decision to hold rates steady reflects its balancing act between controlling inflation and supporting economic growth. Last year, the Fed cut its benchmark interest rate by a full 1 percentage point. This move follows recent comments by President Donald Trump, who, during his first week back in office, said he would demand that interest rates drop immediately. According to the latest CNBC Fed survey, expectations are set for only 2 rate cuts later this year, which aligns with the focus from Federal Reserve officials. For consumers already feeling the pinch of high prices and borrowing costs, this means little relief is on the horizon as interest rates on credit cards and mortgages are likely to stay elevated for now. For your information, the federal funds rate is set by the Federal Reserve and is used by commercial banks to borrow and lend to each other on an overnight basis, and this rate is the foundation for many consumer financial products. And remaining stateside, according to a report released on Friday by the Commerce Department, inflation ended 2024 on a strong note as the Personal Consumption Expenditures Price Index, which is the Federal Reserve's preferred measure for inflation, this showed a 2.6% year-over-year increase in the month of December, and this was a 0.2 percentage points higher than the November reading and was in line with the Dow Jones estimate. Meanwhile, excluding volatile food and energy prices, the core Personal Consumption Expenditures Price Index rose by 2.8% year-over-year, and this was also in line with expectations. And just for your information, the Fed considers core inflation as a better measure of long-term inflation trends. The Fed aims to keep annual inflation at around 2%, but hasn't been able to meet that target since February 2021, as the latest data shows that inflation remains stubbornly above this target, which means that the Fed is likely to maintain its cautious approach towards further rate cuts. In the Eurozone this past week, on Thursday, the European Central Bank announced a 25 basis point interest rate cut, bringing its key deposit rate down to 2.75%. This marks the fifth rate cut since the European Central Bank began easing monetary policy in June of 2024. This reduction in rates comes as no surprise, as markets had already priced in about a 90% chance for a 25 basis point rate cut. The European Central Bank is walking a tightrope, given that on one hand, inflation in the Eurozone has been rising, hitting 2.4% in December, which was the third consecutive monthly increase, and still above the central bank's target rate of 2%. Whilst, on the other hand, economic growth in the region remains weak, as interim data released on Thursday showed that the Eurozone economy saw 0% growth in the fourth quarter of 2024. Meanwhile, the European Central Bank's president, Christine Lagarde, acknowledged the challenges ahead, stating that the Eurozone economy is set to remain weak in the near term. This suggests that the central bank is prepared to continue supporting the economy even as it monitors inflationary pressures. On Wall Street this past week, on Friday, the S&P 500 took a hit after the White House confirmed that President Trump's aggressive tariffs on major U.S. trading partners would go into effect this past weekend. This announcement ended weeks of speculation and sent ripples through the financial markets. The White House press secretary revealed that the U.S. will impose a 25% tariff on goods from Mexico and Canada, as well as a 10% duty on Chinese imports. Stocks initially saw gains earlier in the day, but the mood shifted after the tariff news broke. The Dow Jones Industrial Average, which had been up by over 170 points at its peak, ended the day down by 337 points, closing at 44,544, whilst the S&P 500 also fell, losing 0.5% to close at 6,040. Meanwhile, the tech-heavy Nasdaq Composite slipped by 0.28%, ending the session at 19,627. For your information, tariffs can have a wide-ranging impact on trade, corporate profits, and consumer prices. And that is why investors are clearly concerned about how these new tariffs might affect global commerce and economic growth moving forward. In the U.S. bond market, On Friday afternoon, U.S. Treasury yields moved higher due to increased uncertainty after the White House confirmed that tariffs on Mexico, Canada, and China would take effect this past weekend. The latest gross domestic product report showed weaker than expected economic growth in the United States as the fourth quarter GDP growth came in at 2.3%, which was below the Dow Jones forecast for a growth of 2.5%. In addition to that, on Wednesday, the Federal Reserve kept its benchmark interest rate unchanged and signaled only 2 rate cuts are expected in 2025. Meanwhile, the Personal Consumption Expenditures Price Index rose by 2.6% in December, raising concerns as inflation remains above the Fed's 2% target rate. In response to the foregoing, the 10-year Treasury yield increased by 5 basis points to close at 4.563%, whilst the yield on the 2-year Treasury note rose by 2 basis points to settle at 4.218%. For your information, bond yields move inversely to bond prices, and 1 basis point is equal to 0.01%. In the crude oil market, oil prices eased on Friday and closed the week lower as investors braced for the possibility of U.S. tariffs on Canada and Mexico, which are 2 of its largest trading partners. Canada and Mexico are the 2 largest crude oil exporters to the United States, and therefore any tariffs on oil could disrupt trade flows and impact prices. In the meantime, it is still unclear as to whether crude oil will be included in the current tariffs. For the week, both major benchmarks saw declines, with the global benchmark Brent crude falling 2.1%, whilst the U.S. benchmark West Texas Intermediate dropped 2.9%, and this marked the second straight week of losses for oil prices. On Friday, the price of Brent settled down 11 cents to close at $76.76 a barrel, whilst the U.S. benchmark West Texas Intermediate crude closed down 20 cents to end the week at $72.53 a barrel. In the precious metals market, the price of gold soared past the key psychological level of $2,800, reaching a record high of $2,817 per ounce during Friday's session. This surge in prices was driven by a rush to safety among investors that was sparked by tariff threats by President Trump. Concerns about global economic growth and inflationary pressures have made gold increasingly more attractive as a traditional safe haven asset. Gold is on track for its best monthly performance since March 2024, with prices rising more than 7% in January as investors turn to bullion during times of economic and geopolitical uncertainty. Adding to the volatility, mixed signals from the Federal Reserve and the Trump administration are creating confusion in the markets, with Trump pushing for lower interest rates, whilst the Fed has signaled it plans to hold rates steady for the time being. As uncertainty persists, gold is likely to remain a key asset for those seeking safety, and by the close of day, spot gold was up 0.6% at $2,810 per ounce. And on that note, we now change scene to the Kenyan financial markets, and we start by looking at the cost of living in the country, where overall inflation increased to 3.3% in January 2025, and this was up from 3% in December 2024, and this was largely driven by an increase in food prices. Food inflation increased to 6.1%, and this was up from 4.8% in December 2024. Meanwhile, core inflation, which excludes volatile food and energy prices and is also referred to as non-food, non-fuel inflation, this declined to 2% and was down from 2.2% in December 2024. In the domestic foreign exchange market, during the past week, the Kenya shilling continued to trade sideways versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.25 compared to 129.28 that was recorded the previous week. Meanwhile, the sterling pound was priced at 160.37 and the euro was valued at 134.37. And on the regional front, one Kenyan shilling was changing hands for 28.55 Ugandan shillings and 19.69 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.74. The Kenya shilling continues to trade within a narrow range versus the US dollar, and barring any unforeseen circumstances, we expect the shilling to remain range-bound in the short term. On the contrary, the long-term outlook for the Kenya shilling remains negative, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, Kenya's usable foreign exchange reserves increased significantly by $225 million for a grand total of $8.877 billion, which is equivalent to 4.5 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this fact, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the interbank market, the liquidity situation in the interbank market was sufficient to meet demand and was also supported through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The average interbank rate, which is the rate that banks lend to each other on an overnight basis, this dipped marginally by 6 basis points to 11.23% compared to 11.29% the previous week. And in terms of volume, the average value that was traded in the interbank market declined to 23.4 billion shillings, down from 24.3 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the 4.25% cash reserve requirement, this stood at 16.7 billion shillings. For your information, the cash reserve is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 30th of January, and the central bank received bids totaling a measly 13.46 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 56%. And the results of the auction were as follows. The 91-day rate was flat at 9.52%, whilst the 182-day rate continued to maintain at 10.02%, and the 364-day rate ticked up by about 2 basis points to settle at 11.31%. Up next is our topical issue, and this week we're looking at Moody's revision of Kenya's outlook. The global rating agency Moody's has revised Kenya's outlook from negative to positive, citing a potential ease in liquidity risks and improving debt affordability over time. In changing the outlook, Moody's pointed to the improved borrowing conditions and the potential for better external financing terms should the efforts to raise revenue performance bear fruit. Please note that changing the outlook does not amount to a credit rating review, but rather a forward-looking indication that Moody's might upgrade Kenya's rating in its next full review. Kenya has been struggling with heavy debt repayments and has been looking for new financing lines after the Finance Bill 2024 was rejected and withdrawn following nationwide protests. According to the report, domestic financing costs have started to decline as the central bank has begun easing monetary policy, and this could continue if the Kenyan government effectively manages its fiscal consolidation, which could reopen the doors for external funding options. Moody's also noted that given the low rate of inflation and a stable exchange rate, there is potential for further reductions in domestic borrowing costs as the ongoing reduction in monetary policy transmits through and leads to lower borrowing costs. The rating agency added that a new International Monetary Fund program would enhance Kenya's external financing position, whilst other multilateral creditors such as the World Bank will continue to be significant financing sources. The agency affirmed Kenya's local and foreign currency long-term issuer rating at CAA1, citing elevated credit risks driven by very weak debt affordability and high gross financing needs relative to funding options. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with a friend and help to spread the word around. I really do appreciate your assistance in this effort. And for your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcasts, Spotify, and Amazon Music. Please consider subscribing so that you can be notified every time I publish a new episode. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamhuri@gmail.com. Jamhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, it's not the critic who counts. The credit belongs to the man and the woman who is actually in the arena getting things done. Think about it, Thank you and God bless.